Alright, hi everyone, welcome back to another episode on the beginner series for stock analysis. Alright, again, my name is Jeffet from Rubik's Academy. Now today we're going to walk through this very important ratio called price to book ratio. Alright, price to book ratio. Alright, in the previous lesson, one of the previous lessons, we went through the price to earnings ratio. So today we're going to go through the price to book value ratio. Alright, what they call the PB ratio. Okay, so for the PB ratio, it's actually quite simple. Alright, it's price per share divided by book value per share. Now this ratio itself is not difficult to derive and not difficult to understand, but some of you may have problems understanding what is book value. Okay, especially for those of you who are not accounting trained, you will have a bit of obstacle or even a bit of resistance towards understanding what is book value. So in this very short video, I'm going to go through in a very quick snapshot of how to calculate book value and basically how you derive book value from the statistics that you see on a company's earnings report. Okay, so book value, okay, is defined as a company's total liabilities, all right, minus the way, total assets minus away its total liabilities. So it's trying to ask the question of how much the company is really worth. What is the value of the company after clearing and paying back all its debt? Alright, that is really what this book value means. In other words, as the name suggests, it's trying to ask the question of what is this company really worth on paper. Alright, really worth on paper. And of course, assets would certainly include your cash assets, which would probably be your retained earnings. So if you had earnings from before, you retain it, you kept it in your bank account, that will count towards your total assets. Alright, so this book value is basically the value of the whole company minusing away all the debt that it has to pay. So at the end of the day, what is the real value of the company? Alright, book value is the technical term. Sometimes from the layman point of view, they dare to call it the real value as well. Okay, so this book value is incredibly important because as an investor, we want to know, is this company really as good as it sounds? Is it just an empty shell, or is the valuation based on real solid ground or just hype? Okay, this book value will answer that question. Of course, the book value of certain companies may be lower, right? May be lower, but its perceived value could be higher. So this is where I talk about the difference between book value and market value. Alright, so book value is the real value of the company, but sometimes the real value of the company perceived by the market could be much higher. Alright, this goes back to one of the concepts that I talked about earlier on in the video series, where I talked about basically the gap between technical analysis and fundamental analysis. One of the biggest gaps between technical analysis and fundamental analysis is the fact that there is a difference between real value and perceived value. Okay, and this right here is also reflected. It's the exact same concept, but with two different terms. Instead of real value versus perceived value, now we're talking about book value versus market value. Alright, so some companies may have a very low book value, especially your software as a service companies, especially when they first started out, but yet the market subscribes a very high price to them. Why? Because we are living in a world that is slowly, gradually, but surely and confidently aging towards the importance of data. Alright, software as a service companies, usually their cash flow is not that healthy at the start. Alright, unless you had a big funder right at the start, alright, at the angel or the seed funding rounds. Other than that, usually if your funding size is not too big, your cash flow wouldn't be very healthy, because usually software as a service companies, they spend a lot of money at the start acquiring customers. They don't make a profit like straight off the bat, right? They need some time to acquire the merchants or acquire the customers, or just to cut out the market share for them. But once the customers are in the ecosystem, they will start churning profits, and they will start churning profits in an even more consistent manner than your brick and mortar industries, right? For example, during COVID-19, we already saw that your brick and mortar industries like aviation, like F&B, right, can be easily hit by a pandemic. But your software as a service companies, your Amazon, your eBay, your Facebook, your Instagram, not only are they not hit by a pandemic, they have even prospered. They have prospered even more. Zoom, alright, Zoom is also software as a service. So this pandemic has taught us further that this world is certainly aging towards a data world. So sometimes for certain companies, the book value will be not that good, not that great, but yet the market value is really, really good. And the reason for that difference is, like I said, an example of that difference would come in the form of a software as a service company, whereby the market knows that, okay, I know for now this company is not really doing so well, but their acquisition rate, alright, and the level of product that they can produce, meaning the app itself or the software itself, is good. It's really good. It's good to use. There's no competitor. They don't see any competitors coming. They know that this company will grow at an exponential rate, so they subscribe a high market value to it. Alright, so to get your price to book value ratio, you just need to take price per share, okay, divided by book value per share. So book value per share is easily obtained by taking the total book value, alright, divided by your total number of outstanding shares. Alright, simple as that. Okay, so book value per share is incredibly important. If you want to know whether you're getting a bang for your buck, you need to understand book value. Alright, but I would suggest not using this very simple concept alone. You should use it together with other concepts to get a better understanding. Alright, my name is Jefford. Thank you for listening. I hope this lesson enlightened certain details about the way you analyze a company and the stock of the company. If you like this video, hit the subscribe button. Alright, subscribe to this channel. We have lots of interesting information for you. Alright, thank you very much. My name is Jefford from Rubik's Academy. Download our mobile app if you want to engage in learning. Thank you.